Well, it's noon. I'm gonna go ahead and get us started. Thank you all. Thank you guys all for coming today. We have Scott Pendleton and Aaron Krumpecker from First United Bank. They have some great information. I've already previewed their packets that they're bringing us today, so I already know what they're going to say, kind of, which I was very interested to see some of the things. And I told the agents in the early meeting to come back and pay attention to this stuff because you guys have got some great info. So the way we'll do this is you guys talk, you guys present, tell me, change slide. And I'll change it.
Oh, I want to get around back and see this part.
Yeah. And you're good. You're good presenting from there because the guy they can see you, so you guys are perfect.
I'll give you some round of yours.
Yeah, thank you all for letting us come out. So we obviously have this little slide deck. We'll just use it as a guide, but we'd love for it just to kind of be a fluid conversation. If there's anything we say kind of spurs on a thought or an experience or whatever y'all want to dive into, we'll just have it be a conversation. So some of this will kind of fly through. It's some basic stuff or just kind of general, when to kind of reach out to your lender, we'll fly through those slides. But if you jump to the first one, I think it's just a grid as far as these are all just kind of the basic kind of traditional lending options. And so it's just a nice little guide to show kind of what the maximum loan to value is, or down payment requirements, credit score requirements, what MI might look like, maximum loan amount, and then obviously bankruptcy, foreclosure kind of guidelines and waiting periods. And so that stuff pops up. And so so obviously FHA is, you don't know FHA, but as far as the bond program, that's more of kind of down payment assistance. Yeah. Right. So I don't know if y'all have many folks that ask for down payment assistance. Yeah. Or y'all take advantage of it or utilize it much or kind of know the ins and outs of it or.
I just did one with Bank of America.
Mm-hmm. You got through it.
And they did like a $10,000 grant of some sort. You know what it was, as long as they bought in a certain county, diverse location or whatever, according to some map.
Mm-hmm.
So we did it. We went through it, and it was worth it for 10,000.
Yeah.
America just their right hand doesn't know what the left hand's doing.
That's very true.
So I like those, because I always ask them whenever they speak to the lender to give both analysis, one with the down payment assistance and one without. And we can see if it's gonna fit your monthly budget, because I mean, it's not for free. Sometimes
It's going to be in there.
it's gonna be in there.
Sometimes there's a seasoning requirement to it where you have to have it for 3 years, right? And then it's just forgivable. But if you refinance or sell within that first 3 years, you can pay the full amount back.
Okay.
But at the end of the day, those programs have their own rate, right? So it's going to force the loan into a certain, typically a little bit higher interest rate. So you get money for it, right? So it could be 2 to 5% down payment assistance, right, or cash. The more you get, the higher the rate's going to be. So it's kind of that combination of let's look at this down payment assistance. Can you qualify because it's income specific? It's kind of location specific a little bit at times for some of the programs.
Okay.
And then if you don't need a lot, does it make sense to maybe premium price the interest rate and just instead of get a lender credit to help cover some of that gap and maybe get a little bit better rates? You can kind of mix and match. So if somebody needs it, we can definitely look at it, see if it's makes sense, if it's a valid option for them. Oftentimes we kind of see that maybe it's not, right? Especially with rates being so high, we think that bubble is going to burst soonish. I don't know, maybe in the next 6-12 months, hopefully. And so if they're going to potentially refinance, you don't want to put them in a bond program that they're going to have to pay back $20,000 when they refi, and if prevents them from maybe being able to do that. They don't have the equity.
But that's also area specific. So like that map she's talking about, it goes off of the certain thresholds of like the minority concentration in that neighborhood, plus what the homes are selling for. So it's like targeted areas for the programs that they have. So like it might be the grant for 3, 4, 5% down payment, or it would be the 3-year forgivable. So it just depends on the area too. Those down payment programs. So it's all, I mean, you can do the program anywhere, but then there's different benefits depending on the area. So
And it is income specific, right? They cannot exceed a certain amount.
they can't, it's usually kind of by the county. County is like area media family income, which around here is around 80K, but then certain programs, they can go up to like 120 for the, combined income. But then there's first person. So it's just like so depending on how much they have, like he said, it's like, if they're gonna give you a 7.6 rate and we can give you a 6.8, like you might just make the difference up by giving the client a higher rate and not doing down payment assistance. We'll give it credit.
2 points, whatever, just maybe get a little bit better credit, or a little bit better rate with kind of similar type credit.
So yeah, we could send a comparison of normal down payment, and then if you took a higher interest rate, and see kind of how the cash flows and the monthly payment breaks.
I think some concessions are still okay with in those particular programs.
Depending on, I mean, if you did the 5%, then you'd have 1% left over for concessions. Because it depends, if down payment amounts depend, like if you do anything less than 5% down, you can only usually do.
We have a slide on it.
300%.
Oh, okay,
Yeah.
we're getting ahead, sorry.
No, you're fine.
But yeah, you can mix and match as long as there's enough room to take advantage of that.
For Maria's sake, we'll just skip to the end of the slideshow. and go right backwards.
Yeah.
We're gonna call all of my clients. We're gonna use their.
Okay, any other questions? So what's the USDA RD? What does RD stand for? You know, I know it's a USDA loan.
I think like rural district.
Rural district,
That's
okay.
my guess. I have no idea, honestly.
Okay. Because the reason that I asked that is because we do have our Parker County office and we have our Bell County office.
Okay.
And those people are going to have USDA loans available to them down there where we don't in Tarrant County. But Parker County, definitely there's some areas that you can get out into and get a USDA. If you don't know the USDA program, it's 100% financing.
It's a great program. It's similar to kind of the bond program, right? There's a map, there's zoning. It has the home or the property has to be within a certain area, deemed USDA. And then there is some income, I guess, maximum income levels
Okay.
you can't exceed. So yeah, it's similar to the bond and that there's the specific, but it's a great program, right? Obviously.
Well, obviously, look at it. I mean, 1% for the guarantee fee
Uh-huh.
and the monthly mortgage insurance rate is lower. I mean,
Yeah,
that's a great program.
absolutely.
What is this section 184? I'm looking it up and it looks like it's American Indian.
Mhm.
But
Honestly,
I'm
I don't know a whole lot about it. It's obviously on there. It's an option that we have, but yeah, it's specific to American Indian.
We're headquartered out of Durant, Oklahoma.
Aha.
Probably more.
Okay.
In Texas, it's only in El Paso and Hudson.
Huh. Interesting.
Yeah,
So-
so never mind.
So don't, just pay no attention to section 184. And then obviously the VA, and Danielle and I were having a conversation between the meetings about 100% disabled vet that she's got as a seller client.
Yeah.
So we came to the question, hey, we're going to closing and the US 100% disabled vet pays no taxes. What happens when we get to the closing? Where's the proration? And there's not one.
There is one, but it's on $0.
On $0.
So they still sign a proration form. 0 taxes, stay on the property the rest of the year.
Right. And I think we said-
That comes after closing. We still follow because they have to apply that with the county post closing.
Well, that she's.
I'm the seller.
Yeah.
So my sellers, when I'm running net sheets, are asking, oh, well, the taxes stay on this because I don't pay taxes. And I'm like, that's a really good question. I don't know. Because it
You're
seems
veterans.
like, yes, yeah, you would have to still pay your taxes, but it's prorated, but it's $0 proration.
Mhm.
On the buyer side, we have to count.
Right, what the taxes will be.
And then they go apply with the county
Right.
and get their.
And then they get their escrow back.
Right.
Yeah.
But they're able to take advantage of the first year, so there's no taxes, right?
That's
So
what
it's not
Tyler
like
said.
they don't go in up to the closing table with 3 months of
Back taxes.
Yeah.
No, well, because they have to apply for it after closing,
Right.
right? So we collect that at closing, we qualify them on the tax, with taxes being included, and then they get reimbursed once it's applied with the county, their disabled status, right? And it's $0, and send that back to,
Oh, okay,
back to
okay,
us.
okay.
If the 100% disabled vet was the buyer,
Right.
is what he's
Yeah,
saying,
yeah,
Correct.
as the buyer.
Yeah,
And she's working with the seller
But I'm
side.
just saying, like, say a conventional buyer buys my
Right.
seller's VA.
yep.
They take advantage of that 0% taxes near the end of the year, then they have to be qualified for the full amount of taxes, right?
Mhm, yep.
Or when it kicks in next year.
And there's no max on VA loan amounts. So
What? Like what?
there's no, like, if you go over 726,
Oh,
200
the
as the loan
buying
amount,
limit. Okay, okay.
then you're not like capped at doing 100% financing past that point. It's just whatever their certificate of eligibility says. As long as they have a full eligibility, they could buy a $2 million house for 100% finance. There's no cap anymore.
VA is pretty fluid, right? I mean, from a debt to income standpoint, I mean, we've seen approvals at 65% DTI, right?
I
If it's
just-
a strong fund.
I closed my borrowers went, yeah, I just did it. It was awful. My buyers decided to retire after they got under contract during option. So we went from a 35 DTI to a 64
Oh,
DTI,
no.
but it was approved. So we got it
Because
back
they were being.
because they're VA.
Because they're there. That's what's happening with mine right now, is they have $0 to put down earnest and option money, but are buying a $500,000 house. Because they're qualified for it.
I was just gonna kind of start to clarify, okay.
Interesting.
So yeah,
Okay.
VA is obviously a great program. And so, and conventional is conventional. You can do as low as 3% down, your first time home buyer. And those are, I don't know if y'all have any questions on conventional.
Actually, so from a listing agent perspective, I'm looking at, 3 offers, 1 conventional, 1 FHA, 1 VA. Is one of them stronger to a lender? Or is it just based on what the buyer is doing, or who the buyer is, how much they can afford? Or does a listing agent, am I able to say, well, the conventional, the last couple of years, it's been conventional is such a strong product. But then I hear from some lenders that say, yeah, but there's nothing wrong with an FHA buyer. And sometimes it's a better deal for the buyer to go FHA than it is conventional. So is there a general rule of thumb right now, or is it strictly by the buyer?
I view it similar to what you just kind of explained it. Sometimes FHA just makes more sense for the buyer. It doesn't mean that they're less qualified. Maybe they have less cash, maybe their credit. FHA is a lot more forgiving on credit score than conventional, right? Especially from an MI standpoint. So MI is just set with FHA. If you have a 620 or 640 conventional and you're putting minimum down payment, I mean, your MI is going to be brutal.
Yeah.
I mean, it's just gonna be extremely expensive. So it might make more sense. It's just looking at the whole deal. So it doesn't mean that they're less qualified as a buyer. I mean, obviously the appraisal, they're gonna look at a few more things on the appraisal side, a little bit more strict. So as a listing agent, just, you wanna make sure foundation and roof and cracks and all that stuff are, that there's nothing major. You might be able to get by on the conventional side as opposed to FHA, but
Wood rot,
yeah. Some wood chips. There was wood chips on the outside of the house years ago that we had chip painted on the ground.
Yeah.
And I went out there and swept it all up just to kind of get it done. And we're like in the last, 48 hours to get it done. So it's just a little bit more strict, right? But as far as the buyer quality, I don't think they're any less, right? It's just that they might have a few more dings on credit or whatever, maybe from a DTI standpoint. You can go up to pretty much 56% in FHA DTI. So it's just more forgiving. Sometimes it just makes sense.
Very good.
to go that route. Yeah.
Great information.
Yeah.
And I a lot of the questions that I'm going to ask are like for the people that are sitting and watching us virtually,
Mhm.
because they may be raising their hands and I can't see them right
Yeah,
now.
sure.
So,
Okay.
so I just want to get as much information as we can. All right, so let's move on to the next slide here.
Yeah, so it's kind of just our portfolio as a bank called a conventional FHA, VA. We keep servicing of everything, but we usually sell and package those loans where our portfolio products, we keep them as a bank. And so we price them ourselves and kind of have our own set of rules and guidelines. So With 10% down on our portfolio, you can go up to 1.5. 20% down can go up to 2 million. And then if you really want to, you can, put 40% down on a $7 million loan, which I can't imagine anyone doing. But
Well, just the fact that we can go up to 7, a lot of banks are capped at maybe 3-ish mil, right? And so, I mean, I don't know how many $7 million or $10 million buyers we have, but.
Well, I was gonna say, is that a single family or would that work for like range and land?
I
I mean, if there was like a house on it.
Yeah, well, if it's ranch and land, you would more than likely, so to get around kind of the acreage, you would have to kind of parcel it. Yeah, buy the land for $1 and then all.
Got it, okay.
But yeah, it does work for condos, non-wardable condos. We'll touch on that here in a second, but that follows the same guideline. So if you come across,
I'm speaking of that, is Montgomery Plaza, are they warrantable now?
Ooh, that I don't know. I think so because they have pretty strict rental rules, I think.
Okay.
Because that's what makes it warrantable is the occupancy, right?
Yeah.
Owner occupancy.
I
Yeah.
think it is, owner occupied count, like the ratio.
Yeah.
And lease. I don't know what the numbers are. My buyer, I've been in and out of that building a million times in the last 60 days.
I don't know either, but I would
She's a
think.
cash buyer, that's like.
Well, and I think just due to a lot of the condos in DFW have really strict, like even TMP lofts, they have a wait list for rental units because they want to make sure that they stay warrantable.
Good.
That's good.
That's the advantage.
Yeah.
And you're saying the warrantable is that certificate from HUD? Is that
Right.
correct?
Tells you whether or not, it gives you the information you need to know.
That I don't, yeah, that
As
I don't.
to what the occupancies look like and if it's warrantable or not. I think that's one of the key tools that.
Because I know
Yeah.
the FHA requires that certificate for that particular condo.
I
But
think
the
that
actual,
FHA, if you can find a condo that's approved FHA, I'd love to know. I don't even know if there's one.
there's
They've all, there's one.
There's one.
in Arlington,
Like you can go on HUD and type in whatever county you're in. There's a HUD. You can just look up, there's Google HUD condo approval, and then you pull up the zip code that they're looking in, and it'll tell you every condo complex as a list, and
Interesting.
90% of them will be either approved and expired or denied,
right?
and there'll be one or two that are FHA approved.
Yeah.
Really?
And so they have to basically apply with HUD and FHA to be approved as a condo. So it's a lot of times they're a little bit higher priced because they do have that FHA designation, where some of the other ones that aren't are usually a little bit cheaper because it's like you have to be non-warrantable or cash to get them.
Non-warrantable typically is going to be, so owner to investor occupied, commercial space percentage to residential units. The budget plays into that, and just reserves and all of that. Sometimes if 10% is kind of a magic number, 10% down for a condo. If you put less than 10, it's a full condo review from our standpoint. And we have to get a full copy of the budget. It's just a little bit more scrutinized, more questions we ask. If you put 10% down or more, it's a limited review. And so reserves don't matter. So if somebody puts 5 and that's just a preference, we get the budget back and it's just, let's say they had a big payout. They had a hailstorm came through and they just had, they're building their reserves back up. If they're not approved, then if they put 10% down, we can just swipe that budget and it goes from non-warrantable to warrantable.
Interesting.
And underwriting is flexible with that. So they'll kind of work with us on that. Typically, if underwriting sees something, they can't see it, but for something like that, they'll swipe it and move it off. But yeah, so doctor program, 100% financing up to $1 million, no PMI on that. And then 95% up to 1.5. There's some minimum credit scores there. If somebody is still in residency and they have their job lined up, within 90 days, we can use future income. And if they're still in residency, we completely just disregard their student debt, right? If they're in their new job, it's viewed a little bit differently. If it's a 1099 type deal, let's say that the new gig is based on performance of the practice. Typically, we need a little bit of history there, like a 2 or 3 month history, just to see what reality is. So some of it just depends on how they get paid on their, their kind of full-time gig.
It works for dentists as well, doctor and dentist. And then on that, I mean, I don't know if y'all know, everyone that's in residency, they make 60K a year, no matter what kind of doctor they're gonna be. So usually, if you're like a vet, if someone's like, oh, I'm just in residency, it's like, just know that they're making 60K a year. So unless their spouse is working, 60K in this market's not gonna go a long way. So it might be beating a dead horse. 'Cause I was talking to my buddy residency, he's like, no, I make 60K. It's like, next year I make $62,000. And then like I make 63 the next year. But he was like, well, I'll send
Everyone
everyone.
after that, it makes 500.
Yeah, exactly.
It's paying off 600 and he's running in.
But-
Love that.
I was like, send me all the new people to residencies. Like, unless they're married, they can't afford anything. Like, they're all rented. So, just food for thought there.
So on those student loans, all student loans are taken into consideration, is it part of their BTI?
Not when they're a resident. So when they're in residency, we're not counting their student loans. When they're out of residency and starting, then we have a calculation of that.
So, okay, outside of doctors, if they have student loans. and-
Just in general. Yeah, so if some of it depends, if it's Fannie Mae or Freddie Mac, right? If it's a conventional deal, it's either 1% of the loan balance, if there's not a payment, or 0.5%. Is what we calculate as a monthly payment if it's in deferment.
So the deferment means that they're not making a payment now, but will be in the future.
Correct.
So it is counted in there.
TBD.
Yeah.
TBD on the administration.
Yeah. You go back years ago, we could just discount student debt altogether, but found if you just did that, then once they start making payments, then their debt to income all of a sudden was way out of whack and they couldn't afford the house. So we had to they changed it to where we had to calculate something. So
But I have one that she's holding off because she does have student debt.
But then Paul's starting out, right?
Everything's in
Yeah.
deferment.
Uh-huh. And, but she was also with Countrywide. She got a personal loan from Countrywide to go to school. But Countrywide no longer exists. Yeah.
Well, she feels money to somebody though.
Yeah.
Somebody
That's
bought that
right.
debt.
I have no idea.
Somebody bought that debt.
Well, it depends who's the debt with.
Mhm.
That's better for us. Because I mean, if it's a private money, it's deferred as well. Like it might still be student debt, but if it's a private, if it's not paid by, FAFSA or federal
Mhm.
government, then
It
it
was
might be,
like-
it might be looked at differently if it's not a deferment.
So if it's been 5 years, it'll still affect her?
I
It's
mean,
about $7,000.
How much?
7, and
well, if it's 1% of that as a payment, then $70.
Not much.
months, so
Yeah.
not much.
Yeah, it shouldn't affect her much, regardless of the balance.
As long as it's in good standing.
Right.
So on the one-year tax returns for the self-employed borrowers, do they have to show a nice sweet profit on their self-employed business? Or do you use like deposit statements or, anything like that? How do you factor their viability?
Yeah, so we truly follow Fannie and Freddie from our portfolio. So if somebody's been self-employed for 4 or 5 years, the findings will come back that we just need 1 year history. And we're gonna figure out what kind of income they have.
They
So,
only have to be in business 1 year.
yeah. So, if not, then it's a 2 year history, but yeah, we're gonna look at what the returns say on paper that they make.
So if they've had their business for 5 or 6 years, but they've been S-corping it and writing off a bunch of stuff, they can pay their taxes real well for 1 year and use that to buy a house. That's essentially what we're saying.
Yeah, and we can't tell somebody how to file their taxes, but if it's,
But that's what happens,
If-
seriously.
yeah,
If
if
people
somebody
do
is
that for a
deferred,
reason.
yeah, and they want to buy a house, we'll say, hey, send it over. We'll tell you what your income is, how it looks right now, right? If you have a rough draft, and
Get your
from
income.
there's your info. Take it back to your CPA, and y'all figure out how to mix and match to kind of bump things up.
So let's say that this person doesn't want to wait to do all of that. Can they not provide their bank statements? Is
You want
there, do
stated?
you
Like
offer
just a
bank
bank
statement
statement
loan?
Mhm.
Mhm.
No,
We have,
true.
we have outlets
We have
for
outlets
it.
for it.
I just talked to someone about it the other day. It's just depending on how it works. Like usually it's 10% down, but they have to have a 740 credit, and then it just kind of tiers. 700 is 15% down, and then 680 is 20%, and anything 640 to 660 is 25% down.
Right.
And it's usually like a 9 or 10% interest rate for
That was
those.
just the higher interest
So it's
rate.
usually most times it's usually a little bit higher on the bank statement loans. But we've done it before where it's like, like I had a lawyer come through that makes decent money. We got him on the bank statement loan and it's like, well, rates are still at 7% anyways. So like, and you can qualify based on how your income is structured, but 2 years, a year, if you restructure it, we can refinance you out of that bank statement program. Was kind of the conversation we had. And since it's like, our conversation with our other people that we know as lenders, it's like, hey, can you do this bank statement one? I'll give you this one. I'm probably going to refi it within a couple of years. We just kind of have that verbal, like, hey, we're going to help each other out on this one.
Right. Okay. So when
So-
you say restructured, meaning that when they refinance, it's no longer bank statement, but a regular conventional.
Mhm.
I want to know about that bottom bullet point there.
Yeah.
Mhm.
So we'll go on asset depletion real quick and then go to that one. So asset depletion,
You're pulling Maria on us here.
I know.
But that one caught my eye. I turned my head. I'm like, hey.
yeah.
APV kicks in. That's what we have to ask.
Asset depletion, they have a bunch of cash. And they need to help qualify. Basically, we take, divided by 120 months.
So yeah, our portfolio programs, 120, if it's a jumbo product. So whatever their cash position is, we divide that by 120, we use that as income. And so,
So they have 100K sitting in the bank, we divide that by 120 and whatever that number is what we can use as extra income.
so typically cash doesn't really help you
Whatever
much,
reserves
right?
they have.
Right, because you don't have it in the bank.
Yeah, it's like 100, they have,
Well, just even if it's in their bank, I mean, that helps strengthen the file, but if they have extra cash just sitting around, or if they're retirement age, they don't have a draw or whatever, set up with their retirement, then cash is just there, right? It
Okay.
doesn't really help.
Would
From a TTI
401K
standpoint.
or 401K serve as that too, or no?
What's that?
The 401K.
They have to be retirement age, right? So if they're retirement age, and let's say they have an IRA or 401K and they don't have a draw set up on it, they can set that up. And we go off of, as long as there's 3-year continuation on what that payment is, we can use that as income, right? Now, right, of their retirement age. But if they just have cash and they're not of retirement age, but they have just money in checking, savings, money market, whatever, IRA, then we can utilize that asset depletion to help get a bump in income. So if somebody's close, then that's kind of saved the day quite a bit on some.
Okay. So I've got $100,000 in the bank. I divide that by 120. That is $833.33.
of extra income.
That's their that you call that income.
We call that income. So that's
Okay.
a huge amount of money.
Okay.
$800 on a monthly.
I get that. I had to see, I had to work it to see it.
Yep. And then if it's conventional, so we've worked with a couple title companies that you can move your funds to a revocable trust and use it the same way as if they're retired, right? So as long as there's 3-year continuation, so in the same case, if they just have 100K in checking, if they move that to a revocable trust, and let's say they're self-employed, they don't show a lot of income, what's the math on that?
Because it's 36 months.
Yeah.
360. So it's 200, or not 360, that'd be 30 years.
So that's $2,700.
Okay.
Right, so they can,
What it is.
of additional income, so they have to move it to a revocable trust, set up that first draw. Once that first draw comes out at 2,700, we would probably do it by 38 or 40 months just to give a cushion, because it has to be a full 3 years. But that's another kind of trick that we've used that's allowed by Fannie and Freddie, that to kind of get extra income.
Okay.
And there's no tax implications or anything like that. So
That's
maybe a little bit
super
of
cool.
cost just to kind of move it over for the attorneys to help do that. But
So you do help with that.
Mhm.
Okay.
so, so there is a way to use, a couple different ways to use cash as income, which is super helpful. and bridge loans. So obviously, if somebody wants to go non-contingent, or if their cash is tied up in their home, we can do a bridge loan, pull that equity out, use it for the future transaction. That bridge loan can be on the departing residence or the future residence, just depends on, it's kind of a case by case as far as how it makes sense, and where that loan is attached. But essentially it's just a way to pull that cash out, either prevent them from being, non-contingent, right? Is obviously the hope, or, just to kind of help it be a smooth transaction.
Can you do that on VA?
A bridge loan on VA.
I don't think so.
I don't think so either.
Because that's technically like a portfolio
Yeah.
project. So.
Well, if it's tied to, the departing residence.
So seller is a veteran,
Uh,
has about $150,000 of equity in his house,
mhm.
is trying to buy a new home, but just it's contingent and he doesn't have cash on hand. And so I don't think he wants to put a down payment down, but I'm trying to find a way basically for him to pull equity out of his house, use it for his earnest option money. If he needs to put a down payment down, fine. But to get into his new home,
Mhm.
so it's not.
I don't think
What's the
that's
down
right.
payment?
On
On
his
whatever.
VA?
I mean, VA, it's 0%, but I assume on a portfolio product, it wouldn't be.
Well, portfolio, we can, so if it's on the departing residence, only go up to 80% CLTV,
Okay.
combined loan to value. So as long as there's enough equity there, we can pull, if it's VA on the future residence, right, 0% down, so it's just closing costs. We would maybe need.
Which seller's paying closing cost
Okay. So
on the new house.
On the new
Sorry,
house,
it's just the earnest option money is what he needs.
they like needs.
I need like
5,000,
$7,000.
$7,000.
Oh, and he doesn't have that.
Which unfortunately is not uncommon for veterans, like that's
Sure.
part of it, but.
Yeah. We can figure out a way to make that work.
So the bridge loan, are you able to do it outside of Texas too, or only Texas?
So our port's gonna be, well, we can Oklahoma, so it's where we have depository locations. So
So California's not.
if the departing residence is in California, no, but if it's, we could potentially put it on the future residence. So as far as getting really creative with that, some of that kind of falls with, some of that falls, I mean, that's more of a bank type product, right? So we have folks that kind of handle that on our behalf, so we can kind of give them a shout and say, hey, how can we structure this? Can we put that, can we attach it? Can we cross collateralize the properties, right? And throw that bridge loan on the new residence here in Texas. And when he sells that previous home, that payoff is gonna happen.
Yeah.
Mhm.
Portfolio gives us a lot of creative ideas,
Yeah.
things.
We
Or
do,
is this bridge loan kind of like,
it kind of is like a HELOC. We do have a true HELOC. Honestly, it's not super
Okay.
competitive. But we have it.
You can buy
he's like,
it
there's a reason it's not on the screen.
because it's gold plated. Okay, let's,
Honestly, for HELOCs, I mean, we have a couple outlets for that, just some banks that focus specifically on that are easier to work with. So yeah, I mean, this is one of the quick ones that we can kind of flag. They're just when to contact the lender. We always say the sooner the better, just in case there's anything on credit. You know, even if they're 6 months out, I mean, how many times does a buyer say, I'm 6-9 months out, and then they start kind of looking a little bit, and then kind of everything speeds up a little bit. So we say sooner the better. When it comes to credit, credit's good for 120 days. And so, I mean, if it's as far as how it affects scores, very minimal. You can actually have, if you're shopping, you can have multiple banks pull your credit within 30-day time period. It counts as one inquiry, right? Since the government kind of promotes shopping, even though they don't need to shop, right? They just need to talk to one lender. But anyways, yeah, we always just tell folks that the faster, the sooner we can get it. If there's anything, any hurdles, if there's credit repair that needs to happen or something that they're not aware of, we can kind of talk through that and get a game plan together.
okay, this is the one I was talking about in the meeting earlier that I wanted y'all to see. Because this is a this gonna blow you away?
I'm just, too many numbers.
Okay. Well, let him explain it, because it's pretty, I think it's good.
I'm sure.
It's kind of showing the, what piece of it.
Well, okay, what I was really interested in, because you're looking at the 4% interest rate. I'm sorry,
That'd be nice if rates were back.
yeah, we're not talking about today, but from 4 to 4.25. So that's the interest rate that you're looking at. But then you start looking at how much closing cash you need. It's almost $8,000 less if you get the higher interest rate. $8,000, and your payment only goes up $80 for a 1/4 point difference. Now I'm sure that it's not going to be incrementally. If we went to 6.75 and 7 year, it's not the same thing. These are obviously going to be higher numbers, but just that cash requirement,
Yep.
that $8,000 for $80 a month.
What's the difference? Why?
Okay, so the difference is the interest rate, the 4 to 4.25. Did y'all see that? I didn't see that. Okay, so can you explain why this is less?
Yeah. Yeah. So
What?
rates are.
I'm just laughing because I'm so bad at numbers and I was just like, this is great.
Sounds good.
Sounds great.
Whatever you think.
So why is the 4.25? Why is it less cash to close? Obviously, we know the payment is more because of the interest rate.
Right.
But why is the cash
Well, I
lower?
do see the difference of the plus estimated closing costs.
Mhm.
There's a credit there on the 4.25.
Is
So
that-
rates are, the market's gonna tell us kind of what rates are, right? There's always gonna be a sliding scale on rates. So today it's 7%, right? If somebody wants a 6%, I mean, rates move by an 8%, right? But if they want a 6.5 or 6 or 5.75 or 5.875, that's still available. They're just gonna pay a premium in
Right.
points. It works the other way as well, right? If they're limited on cash, they can take a 7.125 or 7.25, right? So they're giving up some rate, but they're getting a lender credit. So those points are working in their favor. So the sliding scale goes on both sides. So as the market shifts, that 7% today is maybe par. Let's say the Fed comes out and says, hey, we're raising rates, so everything kind of goes up. That scale kind of moves to where now there's, instead of par, that 7% is going to have maybe a 1/4 point in cost or a 1/2 point in cost, right? So it kind of moves where par is kind of up, but the way rates and costs kind of work, if you want a lower rate, you can always get it. It's all about break even, right? Just looking at, if we're talking about a 30-year note and you want to pay a point and it's $600,000 loan, you're paying $6,000 for maybe a 1/2 point of rate. So what's the break even on that, right? Especially in this market. If it's a 3-year break even, it's not a bad break even, but knowing that rates are going to probably come down a little bit and refi is on the table. If you can refi in a year, maybe it doesn't make sense to pay that point, right? To pay that extra cost to get that lower rate. Everybody wants the lowest rate and the lowest payment possible, but what are you paying to get that, right?
So what is your talking point? Because some of these buyers, like the 2-to-1 buying, getting seller possessions from seller
Mhm.
to get them a 2-year
2-to-1 buy
loan
down.
rate.
Mhm.
The unknown interest rate, what historically has happened in the past that lenders typically say they're gonna go down, but what do they don't?
So historically, every single recession, and they don't have the chart on here, but every single recession, rates come back down. Every year, which is the beginning of interest rates. You'll see the graph in 80s, at 19%, recession happens, and rates fall back down. Same thing in the 90s, and then 2008 as well. The rates dipped back down and kind of stayed in that. And basically everyone's saying, in order to kickstart the market again and go from these 7% interest rates, once we have inflation where we want it from the Federal Reserve, they're going to say, okay, it's time to kickstart the market again and let people start using and investing their money. And
But
so
I get, are we in a recession? Because I have.
a financial person would tell you were 2 months of negative gross GDP, gross domestic product, is considered a recession from the eyes of a finance guy. An economist will won't ever say you're in a recession until they have the data to prove that they're in a recession.
That
which
was
is the
2
problem.
quarters,
2 quarters.
2 quarters of decline, which we've had.
Right.
But
Whenever we talked, we went to an event where it was like
something,
the Texas A&M real estate.
That's why you say it's something.
100%.
It is, I mean, it's
We had this
monopoly money.
conversation earlier. I was like, I don't know about interest rates. It's bumping anyways.
It's,
Like all the wonder.
they're putting it at 7 because that's where they're trying to get inflation. And once inflation hits the market they want it to hit, they want to make people start spending money again. So the way to spend money is to reduce the interest rates. And so we've seen that historically happen every time, which is why we say that they're going to drop, because the data we have now doesn't even support a 7% interest rate. Like, there shouldn't be 7% interest rates right now. The data is telling us they should actually be like somewhere in the 5s, based on the way the market's
What I
reacting.
was gonna ask was the 2 and 3% were unprecedented.
Correct.
So now we've overcorrected probably a bit. Is that what you're saying? We've overreacted or overcorrected into the 7s, and then it should maybe regulate a little bit more when we
That's
settle.
the prevailing thought.
Okay.
But
Yeah.
I'm not, so I don't follow these stats, obviously. But I have not seen like from the past where people were not spending. I mean, and I would see it in my own community where a lot of businesses were closing, small mom and pops. That's not happening now.
Yeah.
People
Well,
are still overspending.
I
I mean,
think,
fucking eggs just finally went down.
yeah. Texas is an anomaly though, which is the hard part.
I'm sorry, I lost chat. Sorry.
We need to.
We lost you, you don't like the combo. Are you? I'm
Yeah, you
kidding.
guys lost me. I'm back here.
We see charts in our eyes. We try. We try.
Okay,
yeah,
so
so it's
Texas,
worth
we're our
talking-
own country.
Mhm, yeah.
But yeah, they're still overspending for sure, but also Texas is inflated a little bit compared to the rest of.
especially the major centers, DFW, Houston, Austin, San Antonio. Those places are highly overinflated, which we're seeing in Austin with prices dropping,
Yeah.
coming down.
Yeah.
But all that to say is the 4% costs a lot of money, and is that cost worth it to the buyer? Whereas if you go to the 4.2, you see that they're getting $2,988 back from closing costs because they're taking a higher rate. Where that 4.125 is like the normal rate that everyone would probably get. As if you go shop rates, they're going to quote you at the 4.125.
So moving just a little bit of money.
But actually in this, 4% is probably par because there's closing costs.
Okay, yeah.
4.1 is you're getting a credit to where it kind of alleviates or covers the closing costs. And then 4.25 is you're getting enough of a lender credit to cover all costs plus some.
Y'all have par rates right now? Or are they like coffee?
I mean,
Well,
it's-
I mean, par kind of, sometimes it's split between a true par rate. So 7's kind of where the market is right now
Right.
without paying costs.
Right.
Kind of that ebb and flow. Today, it might have an eighth of a point
Right.
cost.
Okay.
So, but yeah, so I mean, we have this, this is kind of what our quoting looks like. When we send a quote to somebody, we typically will send 3 options and kind of say, hey, this is what it all looks like. These are kind of help wrap your head around ways to structure your loan. Like, does cash kind of speak a little more loudly to you? Would you rather have $4,000 or in this case, $7,000 in your bank account, right? For moving expenses, or just from a cushion standpoint, and pay an extra $80. And so yeah, we like to kind of talk through that. And then obviously, yes, the potential of what rates could be at some point kind of plays into that. So,
Also, you always want to give your clients 3 options. Psychologically, because if you give them 1 option, then it's your fault.
Yeah.
If you give them 2 options, it's their fault because they picked the wrong one. And 3, it's no one's fault because it was kind of crap.
Okay,
and so you alluded to a 2-1 buy down, right? So that previous screen kind of is more related to a permanent buy down, right? So whether you're at par or getting a lender credit, that's going to be your rate for the life of the loan. A 2-1 buy down is a temporary buy down. So I guess the way to think about it is, so a 2-1, so it's a 30-year note, right? On the far right, the note rate is 6.375, right? So when they sign their documents, that's going to be the rate that shows up on the note. So the 2-1 buy down though is for the first year, your rate's going to be reduced by 2 percentage points, right? To give them a lower rate. The second year is going to be reduced by 1 percentage point. And third year, it goes back up to the note rate. And so the way it works, that 92, 39, 45 that's highlighted. So the difference between that first year payment is the difference between those first 2 years of interest kind of relief totals 92.39. So that dollar amount is actually going to go to a side escrow account. And so when they make their payment at 4.375, there's a 508 and change gap in their monthly payment. They're going to pull that from that escrow account to make the payment whole. So the seller covers that. And so that's kind of how it works, right? So
And this is usually done with the hope and the prayer that we're going to refinance in that first 3 years.
I just think that's so risky. I'm
What's the risk?
sorry, but I remember all the
That's why
short
I-
sales
yeah.
from the arms from a long time ago, and I mean, I can see an adjustable rate mortgage if it were locked in for at least, I don't know. But that's $500 is the difference between bankruptcy and not for people. You know
well,
what I
we're
mean?
qualifying them on the higher, so it's still current market rate. So it's not it's kind of a reverse arm, right? I mean, it's a 30-year fixed note. So that's 6.375. Let's just assume that's just the market rate. So you're not paying a premium or anything for doing a 2-1 buy down.
So they can afford the.
So they have to be
25
qualified
and
qualified,
give it to
right.
it. They're just getting
Yeah.
a few years of not having to pay it.
So I guess I'm getting confused. The 6.375 is the current rate now, and it'll be locked in, even if they don't refinance, they're gonna be locked in at that.
Yep.
Even if rates jump to 7%, they're
They'll
locked
still
in
be
at the
good
lower
there.
rate.
Whatever the rate they lock in at. And one major difference, Jana, to me, from what you're remembering from 2009 and 2010, is that the lending was not nearly as tight and as stringent
I
as it is
know
now.
that people's payments will go.
Right.
Oh, absolutely.
And they couldn't afford it, and then they
Then
had to sell. And.
Then we had the short
would
sales.
Probably be in a short position now because we still have some appreciation going on. But still, you know, $500 a month is a lot to a lot of people.
It absolutely is.
It's whether or not you can afford another car.
But
or
you're saying
daycare, or, you know,
they still qualify and they can maintain a payment of the 2548, even if they don't do the.
That's what we're qualifying on.
No,
Qualifying.
they
So that is
Have
more of what-
sell to me for the seller. Why should the seller, you know, a lot of people are trying to get the seller to pay that buy down. I guess builders
It
are
has,
doing it.
builders
that's
and
great.
sellers have to cover that amount. for the
Right,
2-1
right. So I
So,
can see a builder doing it. But
Well,
I can't see
you can also do a
seller.
1-1 buy down. It's really more between us and the buyer,
Yeah.
right? I mean, there's a screen, the next screen will show kind of from if you're listing the house and you have to do a reduction, just kind of how if you offer a 2-1 buy down, kind of what that would look like and how that is a benefit to the buyer. It gives them that lower payment for a period of time, kind of like an inflation buster. I don't know.
Yeah, I
That
mean,
verbiage was kind of
I'm
used.
hard to get sold.
The other thing too, if you think about it, is it's not going from 2,000 to 2,500 in a year.
Right.
You've got 1 year at the 2,000. I mean, our taxes adjust every year,
Yeah.
you know, so
On
it's,
top of that,
it is, yeah, but it's still a gradual, it is on top of it, but it's a gradual change like that would be. And so the reason it's enticing to a seller to say, yeah, instead of giving you this much money in, who cares where it's going? It's seller
Right,
concessions.
Right.
Mhm.
What you're doing is now you're opening up a market for a buyer to say, okay, great. I'm comfortable with this payment. People are malleable, like we're adaptable human beings. So if they know they're jumping, they start paying that. And once the seller's done with it, it has nothing to do with the seller
Right.
anymore.
Especially in a market where houses are not moving as quickly.
Right.
That's a great thing that we could use. Like we had when you and I came on here, that's when interest rates changed in September, October. You and I are standing out there going, these houses are not moving. I don't know what to do. And in that case, that makes a good sense. Now, right now, where you're having multiple offers, absolutely, why would the seller do that? Yeah, why would the seller do that?
And I don't
But now the
think
builders,
A great solution for everybody. So-
well, and see, I got an email yesterday from DR Horton, and they're offering $10,000 bonus
Oh
for a
my
realtor
gosh,
plus
DR
4%.
Horton's so aggressive right now. You can sell a DR Horton. Yeah. Better.
I sold two last week. After but we bought them before the incentives happened, so I probably lost $20,000. But I sold two houses last week.
I'll cover their earnest money and we're going back.
Okay,
Paying y'all an extra thing?
yeah, 10,000 bonus plus 4% in some cases.
And they're also offering.
That's a lot of up north, back down south.
Right, yeah, no.
Up north, yeah,
Up
up north, blinds, fireplace, garage door opener, upgraded light package. And then they'll pay the title policy if you go through DHI. And if you use DHI lending, then they give you money there too. So I mean,
Well, sometimes those deals are so sweet. I mean, you touch them unless you're the in-house lender. But when it's not as crazy as it is right now, a lot of times the in-house lender will just go to that previous screen where it was the 4, 4.8, 4.25. They're getting a credit. Go back. So they're getting a credit of $8,000, right? But they're just giving them a 4.25, right? So they're not giving them anything. They're just using kind of that sliding scale as the lender credit. And so sometimes it's even higher than that. They might give them a 4.5. Their rates might be a little bit inflated. And so sometimes we can easily beat an in-house lender. Sometimes we get destroyed by an in-house lender. So
doesn't hurt to
it's
look
not
though.
always a sweet deal, right?
Doesn't hurt to look.
Doesn't hurt to look.
And on we didn't really talk construction loans, depending on the builder and their relationship, we can even, like First United will cover title policy sometimes. If it's like a smaller builder, I mean, we're not going to cover DR Horton, but if it's a local builder or something we have a relationship with, we'll help title policy and stuff like that. So.
Okay, we got about 10 minutes left and 3 slides to go if y'all are comfortable.
So this is when comparing, so it ties to the previous screen as far as a buy down versus a price reduction, right? And so if you look at, so if you offer that 2-1 buy down instead of doing a 20K reduction in price, it only costs the seller $92.39 and change, right, to offer that credit.
The 2-1 buy down.
2-1 buy down.
Okay.
And then the savings for the buyer ends up being, where is
Buyer, it's like 5.
Oh, buyer down payment, cash requirement? No, it's the same.
I mean, essentially
Well, you're saying the seller paid discount points right here, not there, sorry.
That's the
Right
second
here.
to last one. total
Seller
buyer
paid
benefit.
temporary buy down contribution. So they're giving 9,200 right there.
Right, but then if you go to the second to the last line, the buyer benefits 59, or no, whatever it is. That's second to last line.
Right here?
Yeah, so that's where the buyers say it, I think, right?
That's a permanent buy down.
that's a permanent buy down.
And this is the 2-1 buy down. So if you reduce the offer, if you reduce $20,000 off of the 430 sales price to 410, the seller's it's gonna cost them 20 grand to reduce the price. And then there's no benefit to the buyer. They only benefit 4267 here. However, if you do the permanent buy down, it's a little bit better for the seller, a little bit better for the buyer. If you do the 2-1, it's better for both.
Win-win situations.
Win-win. Thanks for breaking it
But
up.
the
Sly.
92
Teamwork.
on both sides is the savings from the buyer?
Well, yeah, they're just transferring the money from the seller to the buyer. The buyer gets that money to buy that 2-1 buy down. So it's $9,200 for them, and it costs the seller, he has to buy the buy down, but it cost him 9,200 as opposed to reducing his sales price 20 grand.
Oh, that's the 10,760 is the difference.
To the seller, instead of dropping it 20,000, they're only giving up 92.39.
92.
So they keep
They keep $10,000.
The seller, through those savings,
Right.
gets that 92.39.
So as a listing agent, you could offer, say, hey, we'd be willing to participate in a 2-1 buy down if your buyer's interested. And then agents that have been through our training at Sixth Ave would go, oh, I know what that is.
Do the sellers have to sign an actual document where it says, yes, the money that I'm giving is to their?
Nope.
So I've only had one do that. I don't understand why.
Because they're crazy people. Serious. I am working with a builder right now. It's the same crazy buyer, working with a crazy seller that had us sign a form that was like, closing costs will not go to XYZ thing and will only go to XY. Like, why do you care where it goes? Right? Read them out.
Like, why? It's still,
They're crazy. I don't know. I think they think
Who
they're
brought that
saving
form?
the seller.
The seller did.
I think they just think they're saving their seller's money potentially, but it's like, frankly, a lot of lenders can roll stuff into something that's labeled different. It's like, you're not, if there's closing cost agreed upon, let us use it.
exactly.
Right.
So this one was actually the lender sent me that document, which Curtis actually asked me, was like, I thought I gave the credit for land repairs. So I'm like, it is, but they can apply to wherever they want to.
Right.
It's okay, well, whatever. He designed it, but I thought it was odd.
It is.
I'm like, if this is gonna happen with my buyers, I don't care what the lender puts it, as long as they.
As long as they get it.
Once they
Yes.
get it. Yeah, yeah.
And that's what I always
That's-
explain to the buyer, like.
Yeah.
It's cash going towards your closing costs, which then in turn keeps cash in your hands.
Mhm.
So it's not a direct trade, it's sort of a roundabout.
The lender, we might have that in there just to say it's not going to be a direct reduction in your cash to close, right? I mean, it's going to be spread out over the course of
Right.
that 2-year time frame, right? So just to kind of point that out. I mean,
So
any
I
form
guess
that's
if they need
signed
to
is just going to
know,
be
yeah.
CYA at the end of the day.
Yeah.
So, and then there's also like a 1-1 buy down or a 1-0 buy down. So if the seller doesn't want to give as much as that $9,300, they want to maybe cut it in half, they can just do a 1-1 buy down, right? So there's different ways to structure the buy down. It doesn't have to be a 2-1.
I'm asking a lot of questions, but will you tell us how much is needed in order to make sense?
Yeah.
Okay,
Yeah.
because I'm just gonna ask.
HOAs
Oh,
and
this
taxes.
is just, how taxes and HOAs can affect DTI. So it's just kind of a breakdown. We don't have to spend a ton of time on that, but it's just, those are big variables
Okay.
that go into the total equation. And then just closing costs. So this is going back to your initial question of how much seller credit per transaction. So on conventional, it just depends how much they're putting down. If it's 10 or less, they can get 3% seller credit. 25 to 10%, they can get 6. 25 or more, you can get 9% seller credit.
I didn't know.
And
We're
so
gonna
that can
get these
only
right.
go towards,
Huh?
Are we getting these?
Yeah, I'll send it to you.
it can only go towards closing cost and prepaid. It can't go towards down payment. So if it's 9%, that could be a chunk of change, right? So it's either buying down the rate, doing a 2-1 buy down, using those funds, however,
So you will allocate all of the funds
We'll
to
find a way to
wherever,
allocate.
okay,
Yeah.
okay. Nothing will go back to the seller.
No.
Okay.
I had somebody give 25K because they needed a new roof. And it was just 25K concessions. We could only use 15 and we used the other 10 to buy down the rate.
Okay.
Yeah, so.
Yep.
It's a concession, seller needs to give it all.
I will say that's a good thing to talk to a lender about, because I represented a seller earlier this year that agreed to 10,000 in concessions and the buyer only used 7 or 8, and my clients kept up, because that's how it reads, is if it doesn't get used.
Yeah.
It goes back to the seller.
Mhm.
So,
I
Like
reduced
it's-
the price.
I've
I
had,
did
Yeah,
not
that's
want-
last case.
yeah, but
not
I mean, the
want
buyer's
it to go
agent
A
didn't, I don't
2,000
think,
reduction in loan amount over 30 years is going to be
no.
$3 maybe.
Okay.
So that's kind of last case scenario if you have any left over.
But that's good to know that y'all will find a way to use it.
Yeah.
because Obviously not everybody.
Yeah, I was
No.
gonna ask, it doesn't.
I've had
lenders
people
do
leave
that?
$1,500, $1,800 on the table
Sure.
a
They
lot,
should, right?
especially during when we had those big multiple offer things going on. I mean, I had one house that was like, I had 44 offers. The one you offered on when I met you
Yeah.
over in Saginaw.
Mhm.
And the guy that won it, they left like $1,800 on the table.
So it really was a good deal for your sellers.
My sellers were happy. I moved to Florida and bought a boat. All right, last slide. Here we go.
Just the 10 commandments of mortgage. Just don't go into retirement once you go under contract. Don't open up any new credit. You can use current credit cards. You just say if there's going to be any new purchases, washer, dryer, whatever, just send them back to us to kind of talk it through with them. Sometimes it's fine, right? If they're going to pay cash, it's great. We have enough for cash to close, right? We just don't want to get into an issue there.
But it also really matters on how close they are where their DTI is. And so like last week I had the buyers buying from DHI or DR Horton, and they said, hey, we need to get a truck of U-Haul. So it's going to be a couple $100. And you think that's going to be okay? I'm like, yeah, I think, $200 is not going to kill your debt to income ratio, especially because you're getting a moving truck.
Right.
And I knew they weren't close.
Like opening a line of credit Lowe's to buy a fridge.
That's bad.
Also, if you see those paper plates on a car when they come up to the, after we send out letter, let us know, because it might not be on that credit report yet. Have that happen too. They're like, oh, you didn't see it on the credit report? I'm like, it hadn't showed up on the credit report. You just bought it. And you didn't tell any of us that.
Sometimes new debt doesn't show for 3-4 months, right? So we just ask that just tell us everything.
It helps. If we know in advance, we can probably, we can work on it.
Somehow, yeah.
But 3 days before closing is bad.
Yeah, don't buy furniture. We can talk that through, reach Nate. Any inquiries on your credit that's going to pop up, we're going to ask questions on it. Don't make large deposits. That has to be sourced. So cash is not king in the world of real estate, like under the mattress cash. If they're like, yeah, I've got 15K just in my closet in like a little safety deposit box. And they're just going to deposit that. We have to figure out where it came from. So we have to, and that's very hard to do because we have to have withdrawals from bank accounts to total that amount. We have to make sure that it's money that has gone through the system and is, valid money, right?
So like if I came to you and said, I've got $20,000 of just pure drug money, you can't, that's not enough sourcing.
If you say it's drug money, I don't know what I'm going to do with that. But we would have to find a way to have a family member give a gift, and then outside of closing, they can figure that
And he
out.
said like, hey, I've been saving this cash over 10 years and
Yeah.
I want to use it now. You just can't.
We have to have it seasoned for two statements. It has to show up. It can't
The deposit cannot be on the most recent 2 statements. So
Gotcha.
typically 3 months.
If I deposit it now and then I'm closing in 3 months, 4 months, whatever.
Yeah.
It'd be fine.
Yep.
But it's
as long
not,
as it's not on the
value money.
most recent statements, we don't see the $20,000 of direct money, then that's just been in your account.
Okay.
Well, mine's not drug money.
I had a buyer that had horses and he sold a horse trailer and then in turn wanted to use the cash for his down payment. But because it was just a cash transaction, there was no receipts, there was no bill of sale. Essentially what had to happen was he had to get a gift from his dad.
Yeah.
He was able to give his
That's
dad
not
the
the
money for something else.
Right.
His dad had the money invested and he was able to give it his gift.
What if I had $20,000 and I just gave it to my mom and then she gave it back to me as a gift?
Did she already have $20,000
Right,
in
in
an
her
account?
bank account.
Because we have to
Well,
see.
we have to
Okay.
figure it
Yeah.
from.
So if she already had the money in the account and gives it to me and then I just give her the cash, she puts it back.
So however it works, as long as they don't see that you.
Gotcha.
Give it back.
I'm just curious.
There's some creative ways to do it.
And that's the thing with gifts too, they have to be sourced as well. So like,
Like in her bank
Yes.
for months or
Yes.
wherever she got
if
it.
she had $20,000 of cash, you just deposit it in your account, and we don't have a paper trail, we can't count that
Yeah.
20K
Gotcha.
either. Because I had that happen too. They're like, no, my mom had a safe and she just gave me 20K and put it in my account. And we're like,
You should have left it in her account.
well, you can wire it and we won't have to look anything. But if you get it to their bank, we need a bank statement from the bank.
Ah,
So,
yeah, that too. I learned that too.
so if you wire it, then we don't need the
They
paper
don't
trail.
have to.
At all, really.
Yeah,
Title company will provide proof of funds received.
Mm.
But yeah,
So that's kind of a workaround on getting statements from.
but it has to be on the date of closing, right?
So,
then
so
we wire within like
which,
a week.
if I hear you right, so a family member could wire money directly to the title company as the gift.
Correct.
And then it doesn't go through your bank, and then that's all you need is that wire transfer.
Yes.
Correct. Yeah. So we have people come with $0 closing because they got the gift and it was wired straight to title.
Okay.
And then they just sign the paperwork.
That's cool.
Um,
I heard that. I learned that was hard.
We put it on the slide. We just want to go over. Have you all heard of border income? Have you heard that phrase at all? I think it's the rent, like you're renting your house.
If you have a friend, like, renting from you, if you own a house, right? And they're renting and you go to buy another house and you have proof of 12 months receipt of that rental income, you can use that as future income.
Even if it's not on taxes.
Correct. Yeah, we would just do 12 months next year. So you'll have to have a lease agreement for the new house, for the new purchase. But if they pay $1,000 a month and they've done that for 12 months, you can use that as income on the new transaction.
Interesting. Do y'all do, financing for investment properties, residential?
Mhm.
How much higher are the rates generally?
Depends how much you put down. You can do as little as 15.
Okay.
Rates are not pretty.
Yeah.
Probably 7.5, costing at least 2 points. Every 5%. So if you put 20% down, probably a point drops off. If you put 25% down, it's probably par. But it's going to be mid sevens. Yeah.
Going back to that rental thing, so if I'm getting cash from my renter every month as a lease place, I don't deposit that cash into my bank account. I just keep it. Is that still border money or is that, because it's not going to a bank every
We
month?
have to have some type of.
But there's a-
Yeah.
So start slowly,
Yeah.
incrementally this much, and then.
My personal rental. that's
Right,
what I asked.
right. So then next year this time.
Yeah. If you're buying a rental property, when we do the appraisal, we do the rental comp analysis and we can use that as rental income, right? Or use that as 70% of rental income as, yeah.
And that also works with the other one that, and I think it's more prevalent, I feel like, in y'all's area, the accessible mother-in-law suites or accessible dwelling units. If they're up to code, you can also get a rental comp analysis for those. So as long as the appraiser doesn't see anything wrong, if there's, water and whatever else in those units on the back house, we can use the rent from that as additional income. So since they're like, they're having DTI issues and want to buy that house that has the accessible dwelling unit, as long as you get that rental comp in the appraisal and they give you the rent for, $800, we can use that 800 as extra income.
So do you also, like, for those that don't have any credits, that they have rental history and they're able to prove that they've been making their payments? Is that possible?
There need to be a couple different, if there's no credit history or no credit score, then you have to have a couple different documents worth of 12 months, like your cell phone bill,
Credit.
Okay.
rent, and probably like one other utility bill or something.
And that one is a higher down payment, right?
Usually, yeah.
Like 10? Or is it?
Have to double check. I'm not sure off the top of my head what that would be, but I'll get you an answer from that.
Are you guys comfortable with me sharing this presentation with our entire group?
Yeah. that'd
Like,
be good,
and
yeah.
it's going to be in the recording, but I'll put it on Slack. That way everybody has stuff for the slides.
Yep.
I can't thank you guys enough. This has been such a fun hour.
Good.
So enjoyable and very educational, I think. Andrew, do you like?
Oh, yeah, that's very
Cool. Greg? And Greg's gonna not put his Chippendales money in his bucket.
Caveats too. Right?
Yeah.
It's all recorded too, so.
All right, I'm gonna stop the recording now and let everybody's already gone for the now. Stop recording.
So you're saying like 25%